Welcome to the deep dive. Look, if you are tracking the global energy transition, the whole race toward EVs, grid storage, renewables, then, the future really hinges on critical minerals.
Absolutely. And when we talk about securing those essential resources, increasingly we're talking about Africa.
Yeah, it's the strategic cornerstone, isn't
It
it?
really is. The continent holds, nearly 30% of the world's known mineral reserves. Huge amounts of cobalt, lithium, rare earths, PGMs, you name it. But the sources we looked at, especially around African Mining Week 2025, they show the whole narrative. It's fundamentally changing.
Right, so our mission in this deep dive is basically to cut through the noise for you and unpack this. Well, this seismic shift happening in Africa's mining sector, the core theme.
Mm-hmm.
It sounds simple, but it's actually pretty revolutionary. From extraction to beneficiation, unlocking Africa's mineral wealth.
It's a big, coordinated push by African nations to actually capture the industrial value of their resources, not just, shipping out raw materials for low margins anymore.
Right. Okay, so we've sort of identified three central pillars
Yeah.
driving this, right? They all seem interconnected.
That's right. They have to work together. First, you've got this aggressive new policy focus demanding local value addition. That's key.
Value addition, okay.
Second, there's the resurgence of investment. Crucially, it's now very tightly linked to ESG, environmental, social governance criteria.
Right, ESG is everywhere now.
And finally, the really transformative role of digital technology. We're seeing it in exploration, in governance, in transparency, across the board.
Okay, let's unpack this then. Let's start with that big policy pivot. This demand for beneficiation. For decades, the model was just dig it up, ship it out, unsustainable.
Totally unsustainable. Minimal returns left on the continent, almost zero industrial base built from it.
So why the sudden kind of unified policy change now? What's the trigger?
Well, honestly, the economic opportunity is just too massive to ignore any longer. Some sources estimate that if key minerals think lithium, nickel, copper are processed locally, it could actually be 40% more cost-effective than global averages by 2030.
40% cheaper. Wow.
Yeah. That efficiency plus being close to the source,
Yeah.
potentially, it could generate an extra $6.8 billion a year for the continent.
Okay, $6.8 billion annually. That's not just jobs. That's serious national wealth. Industrialization potential.
Exactly. It's about fundamentally changing the economic equation.
But achieving that, it needs coordination, surely. We saw the Africa Mineral Strategy Group, the AMSG, making noise, calling for collective mineral diplomacy. What does that actually mean in practice? Negotiating is one block.
Yeah, essentially it means leveraging that collective market power. Historically, a big multinational could maybe play country A off against country B to get the best deal, the lowest royalties.
Right, the classic race to the bottom.
But collective diplomacy, the way the AMSG sees it, is about setting uniform baseline terms, maybe consistent royalty rates, maybe shared infrastructure demands. They want international partners to bring technology transfer, to bring local processing infrastructure, not just exploration cash to dig holes.
So it elevates the whole conversation.
Yeah.
From just mining permits to strategic industrial partnerships.
That's the idea. And look, we're seeing actual teeth in these policies already on the ground.
Like what?
Well, Zimbabwe banned the export of raw lithium. Namibia followed, pausing new permits for lithium and rare earths exports.
Okay.
And the DRC, the absolute cornerstone for global cobalt, they've put similar rules on exporting cobalt and copper concentrates.
So it's a much more assertive stance on resource sovereignty.
It is. But, the sources also gave a pretty crucial reality check here.
Ah, okay. What's the catch?
Mandating beneficiation is one thing. Funding it, powering it. That's the hard part.
Right. That's the friction point, isn't it? You can't just flick a switch and go from exporting raw ore to making complex lithium-ion batteries overnight.
No, absolutely not. The infrastructure just isn't there yet in most places, especially the massive, reliable power grids you'd need for, say, gigafactories.
So it's the pragmatic first step, the realistic bridge.
The consensus, certainly coming out of AMW, was clear. Prioritize early-stage processing.
Meaning?
Smelters. Refineries, maybe precursor chemical plants, things that add significant value but aren't quite as complex or capital-intensive as full-scale manufacturing. I mean, if we connect this to the bigger picture, currently, what is it? Only about 2% of Zambia's huge copper output is actually refined locally.
Only 2%. That's tiny.
Tiny. So moving that number up towards, say, 50% using local smelters, that's the logical, necessary first step. It builds skills, retains value, and doesn't require 5 years of grid upgrades first.
Okay, that makes sense. Aim high, but build incrementally. So if the policy ambition is there, but the infrastructure needs are massive,
Yeah.
let's talk money. Where's the capital coming from?
Good question. Because this transformation needs serious dollars. You really have to look at the development finance institutions, the DFIs, as the anchor investors here.
Okay.
The Africa Finance Corporation, AFC, is playing a huge strategic role. I mean, the numbers are impressive. AFC's mobilized something like $14 billion in investment.
14.
Yeah, contributing over $50 billion to Africa's GDP overall, creating millions of jobs. And crucially, they don't just fund mines in isolation. They fund the connective tissue, the infrastructure.
Right. Can you give us an example? How does that translate on the ground? AFC spotlighted the Kamoa-Kakula copper mine in the DRC, didn't they?
They did. Kamoa-Kakula is kind of the poster child for this new era of mining in Africa. It contributes about 6% to the DRC's entire GDP, which is massive for one project.
6%. Wow.
And importantly, it's cited as one of the world's lowest emission copper operations because it runs entirely on hydropower.
Green from the start.
Exactly. AFC was instrumental there, but getting the product out efficiently is just as vital.
And that leads us to the infrastructure game changer everyone was talking about, the Libido Rail Corridor.
Ah, yes! The Libido Corridor. This thing is genuinely transformative. It links the copper belt, so DRC and Zambia, all the way west to the Atlantic port in Angola.
And AFC's involved there, too.
Big time. Their strategic investment, and crucially it's got backing from the US and the EU as well, is set to cut mineral export times. Get this. From what often took 45 days.
45 days. That's over a month just in transit.
Right. Bouncing around different routes, delays, down to potentially just 7 days.
7 days.
Yeah.
Cutting 38 days off the transit time, that's not just an improvement. That completely changes the economics.
It radically de-risks the supply chain, reduces inventory costs, makes the whole region instantly more competitive on the global stage.
And that kind of efficiency, that must attract private capital, too.
Precisely. And when we talk about private equity coming back into African mining, it's different this time. It's not the speculative rush we saw maybe a decade ago.
How so?
Because ESG is now the gatekeeper. The sources were incredibly clear on this.
ESG, environmental social governance. We saw that EY research ranking it as the #1 business risk in mining. #1, above things like commodity price swings.
That's the massive shift. Because if you don't have top-notch ESG compliance now, green operations, traceability, community benefits, you basically lose access to global capital markets, or at least your debt gets way more expensive. Reputational risk is huge.
So high ESG isn't just nice to have, it's fundamental to getting financed.
It's fundamental, and it's fueling a surge in M&A mergers and acquisitions. Investors want scale, they want speed, so they're targeting assets that are already performing well on ESG, especially in copper and lithium.
We saw that example of Gulf Capital moving in the $1.1 billion acquisition of Mopani Copper in Zambia by IRH. So new players, but the rules are the same. ESG matters.
Absolutely. And all this new money, all these ESG requirements, they demand one critical thing.
Transparency.
Transparency, which leads us perfectly to that third pillar, digitalization.
Right. AMW 2025 even had a dedicated technology forum. Focused on digital solutions for efficiency, yes, but also sustainability and transparency. So how's tech changing things at the very start, like finding the minerals?
Well, AI, artificial intelligence, is really transforming exploration. It lets companies analyze vast geological data sets incredibly quickly, looking for multiple minerals at once.
Can you give an example?
Sure. There's a U.S. startup, Cobalt Metals. It's got backing from Bill Gates, using AI pretty heavily. They're exploring huge deposits like the Manano Lithium project in the DRC and advancing the big Mingomba copper project in Zambia.
So AI finds the big targets faster.
Faster, and potentially targets that humans might miss. It's not just for new mega deposits either. We saw Botswana Diamonds using AI to reanalyze their existing data.
To find what? More diamonds?
No, to look for other things they might have overlooked before: copper, silver, platinum group metals. AI is basically turning old data into potentially new discoveries.
That's clever, using tech to maximize existing assets. But what about the governance side? Traceability. That seems crucial for the ESG piece.
Absolutely critical. This is where digital governance and traceability come in. A major initiative discussed was the Madini Tokenization Initiative.
Okay, Madini tokenization. Sounds futuristic. What does that actually mean for, say, a shipment of cobalt?
So think of it like creating a secure digital passport or a digital twin for every batch of minerals.
Right.
It uses technology like blockchain to create an unchangeable record of that mineral's journey. From the mine through processing to export, every step is logged.
But you get a verifiable chain of custody.
Exactly. It proves the origin, the value, who handled it when. This is huge for combating illegal mining or mismanagement. If a shipment turns up without this secure digital token, red flags go up immediately. It's not verifiable.
I see. And that digital twin, that verifiable record, that's essential for meeting international rules, isn't it?
Yeah.
Like the EU's battery passport regulations that demand transparency.
Precisely. Africa is essentially building the digital infrastructure to meet those future market demands head on.
And governments are digitizing their own processes, too.
Yes, streamlining things like licensing. Egypt, for example, is launching a digital portal early next year, January 2026, I think. It'll let investors explore different minerals under one license, cuts through a ton of red tape.
That speed and certainty must be a big draw for investors.
Huge! Look at Zambia. Their Zymist digital mining system. It led to a 79% jump year on year in the number of licenses they granted.
79% increase just from going digital.
It makes the market transparent, faster, more competitive, so you combine that digital governance with efficient, transparent logistics like the Libido corridor. You've got a powerful combination.
Okay, this all flows together nicely. Which brings us to green mines, green profits. This idea that green mining isn't just about compliance anymore. It's a competitive edge, a cost saver.
Absolutely. The mining sector globally is a big emitter, about 7% of greenhouse gases. So switching to renewables is vital for the planet, yes, but it's also becoming smart business.
How?
Well, ironically, in many parts of Africa, building your own solar or wind farm or using hydro like Kamoa-Kakula is actually becoming more reliable and cheaper than relying on often patchy national grids or expensive diesel generators.
So it's about energy security and cost savings, not just emissions.
Definitely. We saw concrete examples. Pan-African Resources in South Africa gets 30% of its power from solar now, saved them $1.7 million last year.
That's real money.
And the scale of investment is getting serious. First, Quantum Minerals in Zambia. They're putting $500 million, $500 million, into 430 megawatts of solar and wind, just to cut their carbon footprint by 30%.
$500 million. That's a major commitment.
It is. And it's not just the copper belt. OCP in Morocco, they're a global giant in phosphates. They're aiming for 100% renewable electricity for their huge operations by 2027. This isn't charity, it's strategic business.
Okay, so renewables cut costs, improve image, secure power, and then there's this whole other potential revenue stream, carbon credits.
Ah, yes, the carbon market opportunity. The potential is pretty significant, maybe up to $6 billion a year in revenue for African mining if they can generate verifiable carbon credits.
$6 billion. How does that work? Selling credits for the emissions they avoid by using renewables.
Exactly. If a mine switches from, say, coal power to solar, the carbon emissions saved can be measured, certified, and then sold as credits to companies elsewhere who need to offset their own emissions.
And how does this impact actually financing the mines themselves?
It fundamentally changes the risk profile for lenders. Banks see this potential carbon credit revenue as a plus. It makes the project look safer, greener. Critically, having that verified credit-generating potential can actually lower the interest rates on the project debt, maybe by 10%, even 15%.
Wow, so going green makes borrowing cheaper.
Essentially, yes. A green, solar-powered mine becomes inherently more bankable than an old-school, diesel-guzzling one. It accelerates the transition.
But these carbon markets, they've faced scrutiny, haven't they? Issues around quality, integrity.
Huge challenge. Price volatility is one thing, but integrity is everything. The sources noted only about 12% of carbon projects in Africa currently meet the really high international standards.
So transparency is key there, too.
Absolutely paramount. If the credits aren't verifiable, if they lack transparency, the market loses trust, and that potential financial benefit just evaporates.
And what about the S's in ESG? The social aspect, sharing the benefits.
Crucial point. The African Carbon Markets Initiative, ACMI, is pushing hard for this. They have a target aiming to ensure about 35% of the revenue from these carbon projects goes directly back to the local communities.
So it's not just green profits, but shared green prosperity, ensuring a long-term social license to operate.
That's the goal. That holistic view linking the policy push, the green finance, the digital tech, and community benefit, that's what really defines this potential new African mineral moment.
Okay, so what does this all mean then? Let's try and pull it together. We've covered this big shift to demanding beneficiation adding value locally. We've seen ESG becoming central to investment, and the enabling power of digital tech and green energy.
Yeah, the big takeaway is that Africa seems to be actively moving beyond just being a source of raw materials. It's positioning itself as an architect, an active player in the entire global clean energy value chain,
Demanding a bigger slice of the pie, basically.
and starting to capture that value add that historically just went overseas. By investing in that early stage processing, by mandating transparency through things like tokenization and building reliable green power,
Mhm.
they're laying foundations.
Foundations for long-term industrialization, with the profits hopefully staying closer to home this time.
That's the plan. That's the potential.
But the sources did flag a pretty major risk hanging over all of this, didn't they? Technological uncertainty.
Ah, yes. The
Yeah.
shifting sands of battery chemistry. It's a huge variable.
We're seeing all this research into using less cobalt, maybe getting rid of lithium entirely for sodium ion or solid-state batteries or whatever comes next.
Exactly. And that creates a real headache for governments trying to set long-term policy.
How so?
Well, imagine a country invests heavily, mandates specific infrastructure, say, just for refining cobalt. Then 5 years down the line, some breakthrough happens and cobalt demand just tanks.
Right. That shiny new refinery becomes a stranded asset?
Potentially. The window to really capitalize on today's critical mineral demand might be shorter than we think. Technology moves fast.
Okay, so the provocative thought we want to leave you, the listener, with is this. Given that incredibly fast-changing tech landscape where today's essential mineral might be tomorrow's afterthought, how can African governments make sure their policies, especially those big capital-intensive beneficiation plans, stay flexible? How do they lock in long-term industrial value, even if the specific minerals driving it today change completely?
It's a tough balancing act. The sources seem to suggest part of the answer lies in making sure the underlying infrastructure, the power grids, the ports, the rail lines like Libido are built to be robust and flexible. Flexible enough so that if they're built for mining today, they can support advanced manufacturing or agriculture or other high-value industries tomorrow. That kind of multi-use, resilient infrastructure might be the ultimate insurance policy against technological disruption.
Food for thought. That was a deep dive. Thank you for joining us.